In this quick video, we're going to have a look at how to tackle one of the most complicated forms of hedging that you're going to come across, which is exchange rate hedging, specifically traded options. The way we'll do this is we'll have a look through a question together and we'll show you how you can tackle it and make sure you've structured your answer in a way to maximize your chances of getting a good mark. So what we're going to look at is a little scenario. Let's say today is the 1st of April. We're a UK-based company and we're expecting a receipt of 2.9 million Australian dollars from an Australian company on the 30th of June. The spot rate of exchange today, Australian dollars to pounds, is 184.95 to 185.85. Sterling traded currency options have a standard contract size of £10,000 and are priced as follows. So what they've given you is a premium table. You'll always get one of these premium tables if you are looking at traded options, because this is what the bank will charge you for issuing the options in the first place. So we've got a number of different options there. We've got April and June options, and we've got call and put options as well. What you're asked is, what will our net sterling receipt be on the 30th of June if we hedge using traded currency options? Assume that on the 30th of June the exchange rate is 1.8270 to 1.8345 Australian dollars to the pound. So in this case you'll notice that it means that for this scenario exchange rates have actually in practice on the 30th of June moved in our favour because you'll notice that they've dropped. So essentially when we receive 2.9 million Australian dollars on the 30th of June it'll be divided by a smaller figure, so that's going to be quite good for us. So in this scenario rates have very much moved in our favour. Now before we actually go into the calculation itself, if you remember, one of the most important things to do is to take a step back for a second and do a setup. So we're going to look at the various things that you need to make sure you can do to set the question up, to set the hedge up before we start on the calculation itself. So let's look at the information that we need to gather from this question to let us set the hedge up. There are 4 things that it's worth making sure you can identify. First up, decide what date we're looking for. Now in this case we've been given 2 sets of possible option dates, April and June. Now obviously April is when we're at today. Today is the 1st of April, and June is around the date of the actual transaction. The important thing to remember here is that we always want the option date that is the closest after the date of our transaction. So we don't want April ones. If we're looking at a transaction date of the 30th of June, then we want June options. Okay, so we're going to select June options there. Next up, we need to decide what type of option we want. So do we want put or call options? Now the key to this is have a look at the standard contracts that we're being given here. The contracts, you'll notice, have a size of £10,000. In other words, they're denominated in sterling. So to decide what sort of option we want, you need to decide what we're doing to sterling in the transaction. So when we receive our 2.9 million Australian dollars on the 30th of June, what are we going to do with sterling? Well, in this case, if you think about it, we're getting a load of Australian dollars that we don't want because we're a UK company. So what we're going to have to do is sell them to the bank and use them to buy sterling. So what are we doing to sterling? We're going to buy sterling. And an option to buy is a call option. It's a bit of an awkward chain of logic, but it's an important one. So we know we need a call option, so that's good to know. Next up, we want to know what our exercise or strike price is. In other words, what option are we going to choose to try and kind of limit our exchange rates? Well, in this case, and to be honest, in a lot of questions, what you'll normally find is that they'll just have to tell you what the exercise price is that they want. Even if there's perhaps a number of different options of exercise price or strike price, ultimately they're going to have to give you a clue on which one to use. And in this case, we only have one exercise price in the table, which is 1.862. So that's going to be the one we have to choose. There's no other choice with that. The fourth thing that you need to do to set the hedge up is decide on the number of contracts. Now, watch out with this one because it's a little bit more fiddly than it perhaps feels like it should be at first glance. We've got 2.9 million Australian dollars coming in. That's the transaction that we're trying to hedge. Now, if you have a look at the size of the contract that we are using for this, the traded currency options have a standard contract size of £10,000. Now, unfortunately, that means what we're trying to hedge, the 2.9 million, is in Australian dollars, and our contracts are in sterling. So we can't just divide one by the other to get the total number of contracts. What we're going to have to do is we're going to have to take our transaction, our 2.9 million Australian dollars, and we'll have to convert it into sterling. Now, the rate that you use for that is the strike price or the exercise price that you've selected. So take your 2.9 million Australian dollars, your transaction, divide by 1.862, so that strike price that we selected before, and that will give you the value of your transaction that you're trying to hedge in sterling. Once you've got the sterling figure, then you can divide by the size of the contract, so the sterling £10,000, and that will give you the number of contracts that you need to cover our transaction. Now remember, you can't have fractional contracts. They only come as whole numbers. So round it to the nearest whole number, which in this case is going to be 156 contracts. So quite a few. So those are the four things that you need to identify from your question before you actually go into doing the calculation itself. So now we've gathered all that useful information together, what we're going to do is have a look at how the calculation then works. So how would this hedge work for our 2.9 million Australian dollar receipt on the 30th of June? And in this case, we're assuming, as the question asked, assume that on the 30th of June, the exchange rate is 182.70 to 183.45. So bearing that in mind, let's undertake the transaction. Now, the first thing that we do is to ignore the hedging completely. So forget about your options. What we're going to do is we're going to receive our 2.9 million Australian dollars on the 30th of June, and we're going to pretend we haven't hedged at all. We're just going to go out and convert that at whatever the prevailing exchange rate is on that date. So given the fact we've got the exchange rate at the 30th of June just there at the top of the page, we're going to convert that 2.9 million at the higher rate of 1.8345. If you're still uncertain about whether you use the higher or lower rate when it comes to spreads, remember that spread of exchange rates that you're given there for the 30th of June gives you the buying and selling rates that the bank will give you for the foreign currency. The bank always buys the foreign currency at the high rate and it sells the foreign currency at the low rate. So it buys high and sells low in the foreign currency. Now in this case, we're receiving 2.9 million Australian dollars. So we're selling them to the bank because we don't want them. So the bank is buying and it will buy at the high rate. The other way of remembering this is that the bank will always win. The bank will always charge you as much as it can and give you as little as it can. So given that this is a receipt, we're going to be receiving sterling from the bank, it will want to divide the dollars by as big a figure as possible. So it gives you as little as it can. So in this case, it's going to be the higher rate that we apply. So we end up with £1,580,812 from the underlying transaction. The option is then a separate transaction. Now, if you remember, when we did our setup, we decided that we were going to get a call option. So we have an option to buy. And the strike price we were going to use was 1.862. Use that information for the first part of the option. We have the option of buying, because it's a call option, at 1.862. You can try and do this in total, but I think it's easier just to look at kind of one option at a time here, and we'll kind of multiply it up further down the line. So if we look at an option, we have the option to buy at 1.862. To close out our hedge on the 30th of June, the same date as the underlying transaction, we're then going to have to do the opposite. So we'll have to sell the option back at whatever it is worth on the 30th of June. Now, in many cases, they'll tell you what the market value is of the option or what it's trading at that date. But in this case, it doesn't tell you. We don't have any information on the trading value. Now, you can still work out what the trading value would be of the option on the 30th of June if you remember how options and futures are priced. In theory, they should change in value to the value of the exchange rate on a particular date. Now, in reality, they don't always because of market forces, but if we're not told otherwise, we're going to have to assume that they do that perfectly. So if you have a look at the spot rate that we used for the underlying transaction at the 30th of June, it was 1.8345. If we're not told otherwise, we're going to have to assume that quite correctly, the option has moved to match that exchange rate on that date. So when we sell the option back, it'll be at 183.45. So just use that exchange rate to close out the option, unless you're given a different figure in a question. Now what that means is we end up making a loss, you'll notice, of 0.0275. So 2.75 cents per pound hedged through the option. Now the great thing about an option is that if you make a loss, you have the option of whether to go ahead with that transaction or not. Now clearly a loss, you don't want a loss. So the value of the loss just becomes zero. You don't need to kind of work it out or do any big analysis of it, multiplying up, anything like that. As soon as you see a loss, you just walk away from the buying and selling of the option, and the total value will just be zero. So to this point, our net position is still just 1,580,812. It's just worth saying at this point, we're not quite finished yet, but it's just worth saying, you'll hopefully notice what's happened here. The exchange rate by the 30th of June have actually moved quite favourably. Because the spot rate of exchange is more favourable than the rate implicit in the option, we make a loss on the option, which we just walk away from completely, and it means you get to just enjoy the new, more favourable spot rate. So at this point, our exchange is at the nice, favourable rate of 183.45. Unfortunately, if you remember, when you have options, there's also a premium that you have to pay, which we haven't taken account of yet. So if we have a look back at the premium table, this is the premium table we were given before, we've actually decided which premium we need already, because we know we've got June call options at an exercise price of 1.862. So you can hopefully see from there that you've got a premium of 2.74. 2.74 what? Well, it'll be 2.74 cents, so Australian dollar cents, per pound hedged in the contracts. Okay, so per pound hedged using options. Now be careful with this one, because that's not necessarily the same as the underlying transaction. It's how much you've hedged in your contracts. So if we work out the total premium, it's your 2.74 cents multiplied by how much you've hedged in contracts. So multiply it by 156, which is the number of contracts, and then multiply it by £10,000, which is the size of each contract. What that will give you is the total premium, but it will give you the premium in Australian dollars. Okay, so the premium will be in the wrong currency. You're then going to need to convert that into sterling. Now the key thing about doing this that you need to remember is when the premium is paid. The premium is always paid up front. In other words, it's paid in our scenario today. Okay, and our scenario was April. Okay, I think it was the 1st of April today. So we want to use a relevant exchange rate for the premium as at the 1st of April, not the 30th of June. Now in this case, we have been given, if you remember, the spread of exchange rates on the 1st of April. We always want to use the lower of those two rates. So we're going to use the 184.95. The reason for this again is the kind of logic process we've got to go through. What is the bank doing with the foreign currency with this premium? That premium is something that we have to pay. So we're going to have to pay a lump of Australian dollars to the bank for setting the option up. We don't have Australian dollars because we are a UK company. So we have to buy those dollars off the bank. The bank will sell them to us, and it sells at the low rate, because it wants to charge us as much as physically possible. So it wants to divide through by as low a number as it can. So I've used the lower of today's exchange rate figures of the 1.8495. That's going to give you your overall premium in sterling, which is £23,111. So if we take that off the net position, we end up with our final position here, which is 1,557,701. Now remember, the premium is always paid regardless of whether you have a gain or a loss, so you have to make sure that premium is in there, whatever your decision on the option. Now in that last example, we saw how the option would work if rates had moved in our favour. What would happen if rates had moved against us? Let's have a look at how the calculation would work if we changed the exchange rates to this on the 30th of June. Let's say on the 30th of June, the exchange rate is 187.30 to 188.10. Now obviously that is worse for us because we are receiving Australian dollars. So because those figures have gone up, because the exchange rates have risen, it means when we divide through to get to sterling, we're dividing by a bigger number. So we end up with, unfortunately, less sterling. So rates have moved against us in this case. How would the option work then? Well, you don't need to set it up again. You don't need to come up with those same four things that we did before, because they won't have changed. The only thing that's changed is the exchange rate on the date of the transaction. So we'd set the option up today exactly as we would have done before. So what that means is we can basically just move straight into undertaking the transaction. And we're going to do exactly the same, first of all, that we did in the last scenario. On the 30th of June, we'll receive our 2.9 million Australian dollars and we'll convert them at whatever the appropriate exchange rate is at that date. So in this case, in this new scenario, we're going to use the 1.8810. Remember, we're just doing this as if we hadn't done any hedging, so we wander off and use the spot rate that's available then. Again, we're going to, remember, use the high figure like we did before. Because again, what is the bank doing with the foreign currency? It's buying the foreign currency offers. It's buying the Australian dollars offers that we receive, and therefore it buys high. It divides through by the biggest figure possible to give us the lowest amount of sterling it can. So we're going to end up with £1,541,733. The option is then a separate transaction, just like it was before. And in actual fact, if you remember, the first step is going to be the same. We set this up as a call option, an option to buy at a strike price of 1.862. Again, we'll just look at this on the basis of a single option. So just like we saw before, we're going to buy at 1.862 to start the hedge off. The option will then give us the chance to sell, so to close the hedge out. We're going to be able to sell at whatever the option is worth at the 30th of June. Now again, just like in the last example, they've not actually given us any sort of trading value for the option, so we're going to have to assume that it's shifted in value to the exchange rate that we've used for the transaction, the underlying transaction above. So we're just going to assume that it shifted correctly in value to the 1.8810 that you used in the underlying transaction. Now be careful with your decimal places here, but what you should find, hopefully, is that we end up with a gain in this case. So we've actually sold this for more than we bought it for, of 0.019. Now we like gains. Gains are good. So we're not going to let the option lapse. We're going to take it up and take the gain. So when it was a loss, remember we walked away and it was 0, but the gain we're going to accept. Now the problem is, what does that gain actually represent? What is the 0.019? Well, the answer is it's 0.019 Australian dollars of gain per pound of contract hedged. Okay. Now what that means is if we're multiplying the gain up, it's based on the size of the contracts that you have taken out to cover the transaction, not necessarily the transaction itself. Because remember, you often have to round the contracts up or down depending on how many of them you need for your transaction size. So this needs to be based on the amount of contracts that you've actually hedged. Okay. So what we're going to do is figure out the total value of the gain. So we've got 0.019 Australian dollars as a gain. Like we said, that is per pound hedged in your contracts. So multiply it by the number of contracts, which was 156, and then multiply it by the size in sterling of each contract, which is £10,000. So that first bit in the brackets, if we work that through, is going to give us our total gain, but it's going to give us the gain, unfortunately, in Australian dollars. So we have to then convert that into sterling. What exchange rate do you use? Well, again, you're going to have to, unfortunately, logic this one through. What is the bank doing? Okay. Well, we've got a gain. We've got a gain which is in Australian dollars. We don't want Australian dollars, so we're going to sell them to the bank, and the bank is going to buy them from us, and the bank buys high. Now remember, this gain, the buying and selling of your option, occurs at the same date as the underlying transaction. So this is all happening on the 30th of June as well, exactly the same day as we receive our 2.9 million Australian dollars. So in this case, we're going to use the exchange rate at the 30th of June, and again, we're going to use the higher rate because the bank is going to buy those gained dollars off us, and so it's going to divide it by the biggest figure possible. So we end up with £15,758, okay, as our total gain. So to there, our net position is 1,557,491. Now, is that good, bad? What does that actually mean? Well, essentially what we've done is quite clever to that point. You'll notice that, like we said, the spot rate of exchange is less favourable than the rate that is implicit in the option. Remember, the whole point of this is we've used a strike price of 1.862. So we're trying to make sure that our exchange rate is never any worse than 1.862. Because the exchange rate is actually worse, it's now 1.8810, we've made a gain that has offset the loss that we've made because of the higher exchange rate. So if you were actually to work out to there what exchange rate we've achieved, well, we've got a receipt of 2.9 million Australian dollars. If you divide that by the 1.557 million, you'd end up with an exchange rate of 1.862. So basically we have managed to fix it pretty much exactly at the strike price that we were looking for. So the great thing about the option is it limits your exchange rate, worst case scenario, to whatever strike price you've set. Now remember, that's an interim step, if you like, just to kind of show you where the numbers come from. In practice, you don't quite achieve that because there will be the premium to pay. So in this case, the premium, you don't have to work it out again. It's exactly the same premium it was before, paid up front. So it's that 23,111, and that gives us our final position here of £1,534,380. So that is a foreign exchange options question, showing you what happens if we have a gain or a loss.